Hi, welcome back to the show. Joining us now is our market master for the day, Tushar Pradhan, Chief Investment Officer at HSBC Global Asset Management, is with us. Tushar, hi, good morning. Good to see you in. It's been a slightly rocky terrain for our markets. We've been consolidating in this range of around 8,300 to 8,500. What's the sense you're getting about how the next couple of months could shape up?
Well, we are in for a period of an interesting time in the markets, as always, I guess. For two reasons. One is that the earnings season so far has been fairly mixed. There doesn't seem to be any consensus whether the economy is definitely turned or not. There have been pockets of very indifferent performance, and there have been pretty significant surprises on the upside as well. So that's not really giving any unidirectional movement or momentum to the market so far. So I think till we see some more news coming by, till we see some earnings coming by probably by the end of the next quarter and way beyond that, and see some of the other risks that we are expecting externally to kind of either appear them to be like by way of either an interest rate hike in the US or whatever it is. I think all of these things are very, very critical for where the markets will move. So I guess in the interim for the next 2 months, as you mentioned, it is going to be pretty choppy.
Okay. Hi, Tushar. Good morning. Globally, what's the sense about the India versus China debate? China is up nearly 45 to 50% so far in 2015. It continues to outperform, while India's performance in 2015 has been lagging. It's only up close to about 2%. Will this trade in favor of China continue? And at what point do you think, India will, relatively start looking attractive?
Well, it's been a reversal of sorts. So I think what we're seeing on a year-to-date so far in 2015 has been a reversal of the trend that we've seen in the past couple of years, where China has been very, very insipid. There has been a lot of, I would say, impatience with international investors in China, because for a long, long time China just did not respond. The stock markets, they were pretty tepid, which was also the case in India if you go back more than a couple of years ago. So I guess these are rotational in nature. I don't think there's any link between the two of us. However, I must mention that the Chinese markets appear to be pretty, I would say, volatile for now, because there seems to be a significant amount of supply which is likely to come into the Chinese market. And generally, markets also trade on demand and supply. And if I look at the IPO pipeline, it appears that China will face some headwind going forward. On the other hand, it's difficult to say whether that will reverse in favor of India. I think this year is, as I mentioned earlier, going to be a slightly volatile one for India. Without a lack of any significant earnings up move coming through, we are not going to see a very significant up move in the markets. But I think it's a matter of time. I think FY16 and 17 look very, very strong from my point of view. So I think this reversal is likely to happen between China and India, what we've seen so far in 2015. But that may not be immediate, and that may take maybe 6-8 months before that happens.
Okay, so 6-8 months before that happens. Just coming back to this earlier point you made about, the earnings season being mixed so far, you did mention that there were some earnings surprises as well. Which were the pockets that delivered a good set of earnings in your mind, where there could be incremental money put in?
Well, it's difficult to pinpoint again because it's not sectoral. I mean, there have been companies within a sector which have, not reported that much. Take banking, for example. I think there were certain banks which reported very significantly, surprisingly positive earnings, when the rest of the industry seems to be reeling under asset pressure. If you look at capital goods, I think there were a couple of companies which came out surprisingly much higher than expected, while most of the industry looks to be tepid. If you take cement, I think the same case. So I think what we really want to emphasize is that this is not a unilateral market. I don't think you should look at the average of the market to think whether India is going to go up and down. I think it's becoming much more stock specific, at least for this year. And as the economy turns, there is going to be a lot more unilateralness to the move going forward. So I think for now, we have what we call as a classic stock pickers market.
Tushar, just getting a little specific about ITC in particular, it's a stock which most of the institutions, DIIs as well as FIs hold, and they've been fairly consistent in their holding in ITC, despite the various volatile times that the stock has gone through. But now that we've seen back-to-back disappointments from ITC, and the outlook for FY16 is also not looking very rosy, do you see institutions offloading their stake in ITC, which could put significant pressure on the stock?
Well, it depends on what kind of institution you are. If you look at longer term, long only as we call it, institutional investors, they look at very long-term trends in companies, and ITC is very much rock in the middle of what we call as a very long-term trend in consumer consumption trends. And I think if you look at valuations compared to its own history, if you look at the potential for the business going forward, I don't think there is any reason to kind of say that there is never going to be any interest in the stock. However, I'm not making a very stock-specific comment. All I'm saying is that there will be periods of non-popularity for a certain stock versus others, given some sort of regulatory change, for in this case there has been a significant hike in excise duties, and that has caused consumption to really drop below much of the expectations across most analysts. But I think that's at best a function of what is immediate. I think in the long run, clearly, I think some of these FMCG companies ride on what we call as the India demographic, right? And I don't think there is any reason to believe that India demographic scene is changing very dramatically. So I think it's just a matter of relative valuations. I'm again not making any specific comment. All I'm just saying is that it may not be a very hasty decision which might go in your favor if you decide to keep ITC out of your portfolio right now.
Okay. I just wanted your thoughts on the PSU banking space as well. Until SBI's numbers, we thought that perhaps the asset quality situation is improving. But post SBI's numbers, now there's really no consensus that the worst is over for the PSU banking space. What's your own assessment?
I think if you look at the entire space, I think one conclusion is very clear, that there is stress. If you look at the interest rate scenario, if you look at the inventory situation with most companies, it is all pointing to the fact that there is a severe erosion of liquidity, and unless demand comes back. And again, I will say it is not that much of an asset issue by way of purely an ability to pay back. It's just an issue depending on capacity utilization. So if you have invested a significant amount of capital in capacity, you're not seeing the kind of demand that you expected to see post that expansion. You're not going to see the margins, you're not going to see the cash flow. Until that time, the asset will remain stressed. Does not really mean that the business is in trouble. It just means that it's waiting for an uptick in the economy. So I think the asset issues that we see have to be necessarily understood in the way of when they have to report. So for example, over a quarter, given the RBI rules, the banks will have a certain norm in terms of either identifying it as an NPA for the time being. But I think being in the industry that long and being in the banking industry also, it lets me to believe that bankers don't really view quarter ends as the end and be all of everything. I think there is significant strength in the ability of these companies to turn back once the economy moves around. So it's not really that much of an issue of an ability to pay or an unwillingness to pay. It is really something to do with business dynamics. And I think these are tough times, these are lows in the cycle, and I think the banking industry is just displaying that. So I'm not overly worried about the fact that you're seeing this kind of asset experience. There is significant capital available to be invested in these businesses, and as long as the business environment improves, I think this will be a thing of the past within a year's time or so.
Tushar, investors are a bit concerned because the last time when we got a rate cut by the RBI in March, the markets had topped out. Now this time around, what's your expectations? Are we likely to see a rate cut in the June 2nd policy, and how will the markets react to the outcome?
Difficult to predict for various reasons. One is, of course, the fact that the economic parameters that you look at are turning pretty positive. So if you take inflation as one of the biggest indicators of what the RBI is likely to do, I think that is significantly down. If you look at growth, which is the other reason to kind of hold back on a rate drop, I think that's not very evident so far. So the IIP numbers, while they are slightly higher than the expectations also, it's not really shooting the stars out to say that the growth is back, so we've got to rein in capital costs. On the other hand, there are significant negatives yet left in the economy. As we mentioned, the asset problem, or let's say the quality of the assets problem. So that will also remain a little uncertain from an RBI's perspective. And most importantly, I think the RBI is looking externally. The biggest event which the entire financial market world is waiting for this year is the rate hike in the US. And these are fairly contradictory rate trends. So if the US actually hikes and we are near a rate hike, then it is difficult to imagine that the central bank in any country is likely to drop rates at that environment, because obviously the cost of capital across the world does go up. So in that sense, difficult to call. But domestically, I think the trends are indicating that it may appear that it might be one window that the RBI can do to kind of ease rates for a little while, because I think lower interest rates are necessary for growth, and I think the RBI is well in control of those facts. So I think that's something that they will look to do.
Okay, so finally then, Tushar, since we do have a lot of headwinds, whether it's earnings, whether it's the first rate hike from the Fed, what kind of returns do you think India could give by the end of this year? We've hardly managed about 2% so far.
Well, 2% so far so good. Almost a week ago we were flat. I'm not too concerned about YOY returns really in that sense, because if you take calendar years, really they don't mean much. All I'm trying to say is that investors should focus on the long run. They should focus on equities as an asset class which delivers higher than normal returns across all asset classes over long periods of time. I don't think there's anything which has changed that picture. So if a year goes by where you may have flat returns, negative returns, I don't think there's any reason to write it off at the moment. If you're looking at it from a real near-term view, I still remain positive that what we have to see is a turnaround in the economy. The market doesn't wait for the economic numbers to come in before it starts to price that in. So if we expect that the economy is pushed a lot ahead than what we were expecting it to be, the recovery in the economy, then the market will start to discount that recovery 6 or 8 months prior to that. So which means the second half of this year, I think if the market senses that the economy is turning around, then we should see a little bit of a bounce back in the market itself. And this 2% now could really be a much higher number by the end of the year. But again, as I mentioned, there are so many other variables that we really don't know at this time.
Okay, we'll leave it at that. Thanks for joining us and taking us through the market and, of course, a lot of the cues that are lined up. That's the word coming in from HSBC. But let's talk about individuals.